Hello, what's up? Hello. This is probably okay. This is probably gonna be my last video. I don't know. I maybe I'll make more accounting videos in the future if I want to. But as for now, I think this is gonna be my last video in a while, for a while. Yeah. So let's just get into it. Today we're gonna be making. We're not gonna be making. We're gonna be talking about Chapter 18 of accounting. So, if I can give you a brief overview on the chapter itself, the chapter itself, it's about chapter 18 is about liquidation. So, what happens when a company goes bankrupt? That's basically what chapter 18 is about. It talks about things from chapter 7, such as the liquidation, and from chapter 11, such as reorganization and the accounting treatment for it, right? So yeah, we're gonna start with we have three questions, and to be honest, there's a lot of things to talk about here. But yeah, I'm just gonna try to make it as uh, simple so that it's easy to understand, maybe. And all I've made sure that all the numbers here they're like connected to like the initial data, like the initial numbers, so that you're not really confused about this, like how I got this number and all. But yeah, so let's go into it. First is about financial reporting during bankruptcy. And so basically from these numbers, these uh, they listed they listed the payables, and we have cash. We have limited amount of cash, but lots of payable. And so how are we supposed to distribute this cash? And so when we talk about corporate liquidations, when we go bankrupt, we have limited amount of cash to pay. We cannot pay them all. So we got to set priorities, right? So there are payables that are more prioritized, such as the notes and the mortgage. And we secure the amount, like the collateral value. That's how I call it. Like we can pay that first before we pay everything else. So that's exactly what I did here. So yeah, look at this. So this is the initial cash, and this is the notes payable, this is the mortgage, and basically I paid off these two first. I took this from this is like the secured amount, like here, it is stated. And basically after I do that, I went on with administration because that's the order, right? Administration expense, and then I went with uh, the unsecured priority ones such as salaries, and then the rest goes in unsecured. Now, what I really want to note here is that when I go into unsecured, the amount of cash that I have left versus the amount of cash that I needed to pay them is not enough. And so I need to distribute them on a pro rata basis. So what I'm trying to say is that they'll get the cash available, but it's like they have their own proportion. So basically, I calculated the proportions using this, and then basically dividing the rest of the balance with the total unsecured claims, and then I just distribute them using this basis. So it goes like this, and yeah, you have the numbers here. And so that's how I did it. And so the key takeaway here is that you cannot pay all of your debts because you're going bankrupt. So then you have to kind of make sure that they get the portion that they deserve, even though the amount is not it. So yeah, moving on to the second question. It's about financial reporting during bankruptcy. You have balance sheet here, and basically they ask you to determine the amount expected to be available for unsecured claims, recovery per dollar, and the amount of recovery for each class of creditors. So for the first number, um, yeah, I just calculate this. You have the amount, which I took it from the balance sheet, and then I listed here it's paid by which account because each account is secured by different. like accounts. For example, notes payable is secured by notes receivables, so it's like that. Then there's the amount, and so then we can calculate if the total debt is this and the amount that can be secured is this. That means there's still portions that are unsecured. So yeah, I just calculate that, and then we get. Oh wait, my laptop is running low, guys. Hold on. I'm just gonna do this while charging. I'm really sorry for the delay, but yeah. Huh. Okay, are we back? Are we back? Are we back? Okay, I'm really sorry, but yeah. Moving on. So basically, what I was about to say is that you have the total debt, and then you have the amount that is secured. Then there must be amount that are unsecured. So I basically calculate that here, and this is what I got. And what I want to note here is on the mortgage because the plan asset has more value than the mortgage itself. So then I just listed the amount secured as the same amount, not 300, but it's just the same amount. And so we can get the unsecured portion of like 0 just to make it like easier. But yeah, that's why there's like more calculations here. And yeah, we initial balance we have 620. That's like the total assets here that we will be using to pay, and the amount that we secure is 500. So then with the addition of liability for priority claims, which is in the account as well, we would have the rest of the balance of 20K. So yeah, that's that. For number two, we are needed to calculate the recovery per dollar. And so what recovery per dollar of unsecured claim is basically the total unsecured claims divided by the available cash we have. So yeah, we don't, again, we have more unsecured claims than the cash that we have, so we cannot pay them all. And so to calculate that, we just divided the unsecured claims by the available cash. Unsecured claims, I got it from liability for non-priority claims and the excess of the unsecured portion, which we have calculated before. So yeah, that's for the recovery per dollar. And for number three, they want me to list like the amount of recovery for each of the class. So starting off with the secured ones, this is basically just repeating from number one, and then we have the priority claims also from number one, right? Then we have the rest. So this is the idea where you only have a limited amount of cash, but then you have like excessive debts, so you have to pay them all, but then you have to make sure that you pay them fairly using the 20K. So I just distribute according to their proportions. And so this is what they get. Non-priority claims gets 10K, notes payable gets 6K, and mortgage gets 4K. So yeah, that's that. And for number three, there's this one is a lot of work to do that I had to do, but then yeah, as you can see there, basically number three, I mean like problem three asks us about there's like a balance sheet here and the whole reorganization plan, and we first need to determine whether it's eligible or not. So the first key to determine whether it's eligible or not is we want to see whether the reorganization value exceeds the total net assets or not. We want to make sure that exceeds the total net assets, because what that means is that if it exceeds, that means that previously you don't have enough net assets. You can think of it kind of like in that sense, because you're trying to make your company new, but you can't really do that if your company was still were still able to run. And so you can determine that by comparing the reorganization value with the total net assets before. And so from comparing, we get that the reorganization value is more than total net assets. So then the eligibility is, I just put here like yes, it's eligible. On the other hand, the company, we can also see that the total equity uh, equals total assets here, right? And so we can also say that because the equity equals kind of the asset, that means that you, with your assets, you still can kind of get the, you still can kind of pay the equity. So the company was not truly like insolvent, but then again, they're not going bankrupt. They're just doing reorganization, and I think you can still do it because I forgot which regulation, but somewhere in the like in the GAAP, like the accounting standards, they allow the criteria in which company can will be allowed to perform the organization is this. We're mainly focusing on this rather than the other. I'm just doing this for the sake of giving more just information, but then we're going to be looking at this. So because your organization value is higher than the total net assets, that means the company was like struggling in a way. So then, yeah, you can reorganize your company. It's like that. For number two, we need to prepare journal entries. Okay, so then yes, they can reorganize the company, right? So what do they have to do at first? um, Accountants, they need to make journals, right, to adjust to this new organization. And so first we want to eliminate the prepetition liabilities, and what that means is that we want to eliminate these basically. Wait, I'm sorry. By that I mean we want to add these. I'm sorry, because this is like a credit account, right? And so you eliminate the liabilities and you transfer it into these, right? Second is you want to adjust assets to its fair value because it is stated there's like a fair value here somewhere. And so I have provided all the calculations for this, where I get the numbers from. You can always like look at the table. And but yeah, we want to adjust assets to fair value, and we want to also eliminate the alt stocks and make input the new stocks because you're reorganizing. So your stocks is going to be new, right? So you eliminate alt stocks and debit, and you put new stocks as well as the additional paid in capital. Because for the calculation, yes, there is additional paid in capital. And in here on to the right, I have provided kind of the calculations that I did. You know what? Maybe I'll put like a little thing here, calculation of uh, assets adjustments. Yeah, I use this for the second entry. But yeah, so yeah, that's basically it. And for number three, we have to prepare like a new balance sheet. And so I just did. I just prepared a new balance sheet. It goes like this. Maybe what I want to say about this thing is that notice how the total asset is 16. This is also 16, equity and liabilities. And I plugged the goodwill numbers as well as the retained earning because you would goodwill is because since how do I explain this? Because like you have your assets, right? But then you have your reorganization values. There must be some kind of goodwill, like a good intent. Yeah, basically goodwill. And also retain earnings. I put retain earnings, and it's to also adjust to the total assets of 16K, which is based on the reorganization value. So the two coins that I use here to adjust to the organization value is the goodwill on the asset side and retained earning on the liabilities and equity side. But yeah, this is the balance sheet. This is how it looks, and I put the notes here as well. But yeah, it's a bit short, but I have made sure to include to make I have ensured that all numbers here are like taken from like another cell, like the cell from the table, so that if there's any calculation happening, you can see it clearly. But then, yeah, let me know if I did anything wrong here. Maybe I did. Maybe I did everything correctly. Like maybe I got everything correct, but then using the wrong way. Always let me know if there's any feedback and all. And Yeah, man, I'll be seeing you. I'll be seeing you in the future somewhere. I don't know. But yeah, bye bye for now.